Hi students, this is Professor Arnold and this is a tutorial on gross domestic product. A question related to gross domestic product, which we call GDP. Well, GDP is the way we very often abbreviate it, is how well does gross domestic product measure societal's well-being? And I'd like you to consider that throughout the entire tutorial, and then we'll come back to the question at the end. I'll be referencing it a little bit as well. So obviously, to even begin to answer that, we need to find out what we even mean by gross domestic product. And the definition of gross domestic product, you can see it written here: the market value of all final goods and services produced within a nation's borders. So I want to unpack that a little bit. First, what do we mean by market value? So market value literally means what something's sold for. If there's two pairs of shoes and one pair of shoes sells for $50, the next day they discount the second pair and it sells for $25. The market value of the first is $50, the market value of the second is $25. Again, literally, what they sold for. Final goods and services means the final or the last time something's sold. So if you think about purchasing a car, let's say you're going to become energy efficient and you're going down to buy a Nissan Leaf, there's tires on that Nissan Leaf. And the Leaf manufacturer purchased the tires. So the first time they were purchased by the Leaf manufacturer, they were actually considered intermediate goods. I have no stylus. You are going to have to put up, unfortunately, with my skill, or lack thereof, of writing with my finger. Intermediate goods. So an intermediate good is something that will be sold again, that is sold the first time. So the Nissan manufacturer bought the tires, and the tires become part of the sales price of the car. So when you buy the car, you're actually paying for the tires a second time. But that's the time that counts. We only count final goods and services the final time it was sold. Don't get confused by thinking that a consumer's purchase is always final and a producer's purchase is always intermediate. Because if you consider a situation of an oven, and you may buy an oven and then it's a final good, but if a bakery buys an oven, it's also a final good, because they're never reselling that oven to you. With the tires, those tires themselves were being resold to you, but the oven isn't. So the same bakery probably bought sugar, let's say a pound of sugar, and they put a cup of it in a cake that then they sold you. That sugar was an intermediate good to the bakery, because that sugar itself was going to be resold. So if the product itself will be resold, it's an intermediate good the first time, or the second time, or the third time, all the times except the last time. But if the good is used in a production in a way that it won't be resold, such as the oven, it's then a final good. So just simply think of final, no matter who it's sold to, is simply the last time a product is sold. Produced within a nation's borders pretty much means what it says. So we contrast this with gross domestic product. We contrast it with gross national product, which a couple decades ago used to be the number that was reported most, but now gross domestic product is. And gross national product would include all production if the owner of the company is a U.S. citizen. So if you think about, say, a Toyota factory in Ohio, that would be included, the production of those Toyotas, that would be included in gross domestic product because it was produced within the U.S.'s borders. It wouldn't be included in gross national product. If you think then about Nike with manufacturing plants in Mexico, however, that's not included in gross domestic product. That would be included in gross national product. The reason that gross domestic product is used now is because if we go back to my original question of let's go back to my original question. How well does GDP measure a society's well-being? Something being produced within our borders is a more accurate measure of our society's well-being because they'll be employing people who live in the United States. We can measure GDP in two different ways. We can do the expenditure report approach or the income approach. And remember that GDP, we're measuring how much everything sold for, basically. And so it seems very clear that then we can certainly figure out all the different groups of people who are purchasing and all their expenditures, and then that would add up to everything that's purchased. But it also we also can track the money people make by selling this. And you're going to get pretty much the same number. We have to do a couple accounting things to make them match, and we'll go over that when we hit income approach. But think about if you decide you need a new couch and you go down to your neighborhood furniture store and you give them $600 and you get a new couch. That's an expenditure and it's also an income. And this should sound familiar to you because we went over this in the circular flow diagram, which you were exposed to at the beginning of the semester. And go ahead and review that tutorial if you need to. So let's talk first about the expenditure approach. And throughout the semester, the expenditure approach is the one that we'll be referencing the most often. The income approach, we'll need to know what it means, but we're not going to actually take it and use it later on. So the expenditure approach basically has all the components of anybody who's going to be spending and purchasing things. We've got consumers, we've got firms doing investment spending, we've got the government, and we've got exports and imports. Let's start with consumption. Consumption is very straightforward. If you're a consumer, you go buy something, it's a consumption expenditure. About 2/3 of gross domestic product, which is about $19 trillion at the time I'm recording that, are consumption expenditures. And they don't need much explanation. Investment expenditures are actually expenditures by firms. If you remember back to the factors of production or the categories of resources, you'll remember that they're natural resources or land, labor, capital, and entrepreneurship. Well, investment is associated with capital because remember that capital did not mean financial capital in economics. It means either physical or human capital. And physical capital is things like the plant that something is produced in, meaning the factory, equipment, the equipment, even maybe the trucks or some of the roads to get something that they have to get the product to you. It's anything that is physical, it's man-made, and it has to do with a manufacturing process or a sales process. So a firm invests in, meaning purchases, physical capital so that they can then produce the product. Human capital is training and education. Training. I think it's more legible if I do cursive. I'm not sure about that. I think so though. Training and education. So you'll notice that the line I drew when I was explaining investment, I drew from fixed investment because these are fixed investment. So any purchases of any sort of equipment, anything to do with manufacturing, any training, any education is called fixed investment. Inventory investment, that's pretty straightforward. Inventory investment is a little more complicated. And inventory investment literally means, and I want to put a little triangle here. Triangle means change in math. So what we're really going to track here is changes in inventory, and we're going to call it inventory investment. So let me give you an example to explain what I mean. We'll go back to the bakery, and we'll say that on December 31st, 2017, this particular bakery closed its doors at the end of the day, and on its shelf it had $12 worth of unsold cupcakes. That's actually considered investment. And of course accountants decide where to categorize everything, but the logic for this being investment is it is some sort of spending that was done such that the company can make more money in the future. So think of the oven they purchased, which would have been fixed investment. That spending was done so that they could produce and sell more cupcakes in the future. Well, if you have cupcakes in your bakery when you close your doors in 2017, then you have them to sell in 2018. We'll ignore the fact they probably have to be marked down for day-old pricing. So that would be inventory investment, but notice that I added a triangle, so what we've got here in terms of GDP is change in inventory investment. So let's fast forward a year, 2018, and say we close our doors with $20 worth of cupcakes. So you can see here, if you look at and compare these numbers, 12 and 20, that we actually have $8 more of inventory in 2018 than we did in 2017. So our change in inventory investment is $8. 20 minus 12. We're going to subtract the previous year. You can see that inventory investment could be negative here as well. What if we closed the door with $5 rather than 20 in 2018? In that case, our inventory investment would be 5 minus 12, which is negative $7. So consumption, fixed and inventory investment, those are two of the categories. Government spending is another category, and we want to be sure that we do not include transfer payments. Hold on just a minute. Transfer payments are payments such as Social Security, food stamps, women, infant, and children programs, all types of government welfare. I'm going to write it here, but in my writing it, don't think it's included, because it's important to know that these are excluded. Excluded. Oops. What's included are government purchases of goods and services, but also any payment to government employees that deliver goods and services. So, for example, because the government produces a lot of its own products. So let's take, for example, Caltrans, California Department of Transportation, and if they're going to widen a freeway, they will contract out some of the work, and they'll have their employees do some of the work. So both of those are included. When their employees do the work, that's not something that's purchased on the marketplace, like it is when they hire a contractor, but both of those are included. So it's basically the cost of the government, to the government, or by the government, of whatever it produces. Exports minus imports, I've written as X minus M. Sometimes you'll also see it written as X sub N, or net exports. Sometimes you'll even see it written as net X, again, net exports. And basically it means what it says. We're going to add what we sell to people from foreign countries, that's exports, and we're going to subtract what we purchase from foreign countries, that's imports. For maybe all the years of most of you all's lives, this has been a negative number. So generally X minus M is going to be a negative number. So all these categories of people, when they purchase things, the payments made for those are either going to come in the form of wages, rent, interest, or profits. And although it doesn't hold completely, we often connect these with the factors of production. So we connect wages with labor, we connect rent with land. The land factor of production is another name for natural resources. Oops. Yeah, no, that's right. We connect interest with capital spending. And the reason is that when firms expand and they do capital spending, they're usually borrowing money. And if you're the person that loans it to them, you get interest. When we think of land as sort of a plot of ground that may have a building on it that gets rented out, that's why we connect this one with rent. And profits we connect with entrepreneurship. And that is because that's what entrepreneurs make. I'll stop right there. Hard to spell and hard to write with my finger. So wages, rent, interest, and profits make up gross national income. And again, we can calculate gross domestic product using either the income or the expenditure approach. We call this gross national income because we're using the income approach, but also because to actually make it match gross domestic product, we need to add two more things. One of them is depreciation, and this is just for those of you who haven't had an accounting yet. This is just an accounting and a tax construct. That has to do with the fact that equipment actually slowly wears out over time instead of all at once. I didn't mean to write depreciating. I meant to write depreciation. And the other one is taxes paid by businesses. And we're going to call these indirect business taxes. Indirect business taxes, because taxes that the business is paying, who receives payment in the expenditure approach from all these categories, some of it will go in wages, rent, interest, profits, but also there's taxes that the firm may need to be paying to the government. So that's what that is, indirect business taxes. So now that we know how gross domestic product is calculated, and particularly, again, we're going to focus on the expenditure approach, But now it's time to analyze a little bit, just look a little bit more closely at what this way of measuring is about. And the first thing we want to look at is what's not included. We already know intermediate goods aren't included, but in terms of any sort of final goods and services, second-hand goods are not included. And the reason for that is to avoid double counting. It's the same reason that intermediate goods are not counted. We don't want to count the sale of something twice. So your garage sale expenditures are not counted. And they're not just not counted because they're not reported to the IRS, so there's no way to know. They're just not counted. Non-market activities are not counted either. And a non-market activity, most of these are household functions. So if you go out and mow your lawn, it is not counted. If you hire somebody to mow your lawn, it is counted. If you take care of your children, it's not counted. If you hire somebody to take care of your children, it is counted. So this is kind of interesting because we basically got the same activities going on, but in one case they're counted in gross domestic product as a measure of our well-being, and in another case they're not. And the third category is the underground economy. Underground economy can either be legal or illegal. So when you hire a plumber to come to your house and he cleans out your drain and he says, prefer you pay me in cash, it's very likely he's not going to report that money. So that would be an example of something legal that's part of the underground economy, simply because it's not being reported. Illegal are things that are illegal. Very unusual for somebody to report their drug money to the IRS. I would say probably never happens. So illegal activities are not included in GDP. Legal activities that are underground are not included. And in these cases, and we expect these are over 10% of the economy, in these cases it's simply because we don't have the data to count them. Second-hand goods are not included because we've already counted them once, so they're only associated with production once. And non-market activities aren't counted because they're not valued. We don't have a way to value them. So in all of these calculations of GDP, when you look at what categories things go in the expenditure approach, when you look at what's not included, remember these are accounting decisions. They're not written in any sort of stone or any religious text anywhere, and we could change depending on what we want to know and want to calculate. We could change how we do things. So this is how they're done in this country, and we can't argue the rightness or the wrongness of it in terms of anything absolute, only in terms of how well it works. And speaking of how well it works, how well does it work? I've written problems here and I've put a question mark because it's going to be up to you to consider whether you think these are problems or not. And one thing about GDP is it doesn't subtract for loss of goods and services. So at the time I'm recording that, we just had Hurricane Harvey, Hurricane Irma, and Hurricane Marie, one right after the other. And a lot of destruction. And none of that was subtracted or will be subtracted from gross domestic product. But the rebuilding will be added to gross domestic product. So are you better off if your house was destroyed and then you rebuild it? According to gross domestic product, yes. It also doesn't subtract for the loss of goods and services in terms of environmental degradation. Of course, those would be future losses. Mostly future losses, not completely. So if you think about a firm that's giving out off a lot of air pollution, And the people who live around there will have a higher rate of doctor visits, of medication for respiratory issues. That's not the loss of their quality of life, even possibly of some days missed, is not subtracted from work, is not subtracted from GDP. Now, days missed from work, if it means there is not as much production, means not as much will be added, but nothing's actually subtracted. And in fact, the medicine being sold, the visits to the doctor or the hospital, they are added to GDP. GDP also doesn't place a value on leisure time. So as a society becomes more wealthy, people may choose to take longer vacations. Some may even choose to only work part-time. They may choose to stay home and take care of their children if they're wealthy enough to do that. And none of that is valued in gross domestic product. We don't have a way to capture the value of people's leisure time. And the last problem that I want to highlight here is it doesn't differentiate between healthy and unhealthy goods. So a green drink is going to get the same value, dollar for dollar, as a packet of cigarettes. Those are not distinguished, one from the other. So we're going to move on here. If we go back, you see we've talked about problems here in terms of, which I hope you're thinking of in terms of our first question, of how well does GDP measure or reflect the well-being of a society. And now we're going to look at this from a little more of a basic sense. And that will, what I'm trying to say here will become more clear once we go through these examples. But this is based on the numbers as they're calculated, not questioning how the numbers are calculated, whether they include leisure time or secondhand goods or whatever, but just the numbers themselves. How is that working in terms of measuring a society's well-being? And we've got two new terms here, nominal and real. And basically real is going to mean, and I'll show you what it means, you'll know when we do our example more what it means, but real basically means that it's going to be adjusted for inflation. So let me just write that up here. I only think I'm going to write that up there. I'm going to write it up there so I have plenty of room to write. Adjusted for inflation. There we go. Let's do an example. Then you'll know what I'm talking about. Let's pretend that we live in a very little society, and that little society has one apple tree that is not doing very well, and it's giving off one apple. So that is all the goods and services produced within our borders in 2019. And how about we sell that apple for $1? So the definition, the market value of all final goods and services produced within a nation's border is basically one apple times $1. It's the market value. So that is nominal GDP. Nominal GDP is measured in terms of the actual sales price. So real GDP, adjusted for inflation, we're going to say that we're not adjusting anything for inflation yet because we're going to call 2019 the base. Whoa. just hope I can get that back. We're going to call 29. I'm writing too close to the left hand. We're going to call 2019 the base You guys are going to be so happy when I get a stylus before I do another tutorial. Actually, most of the tutorials you're seeing were recorded when I had a stylus. Base year. So 2019 is the base year. So when we figure inflation, we're always going to compare it to 2019. So in 2019, GDP adjusted for inflation is 1, and nominal or current dollar GDP is also 1. So let's see what happens in 2020. In 2020, our apple tree is not doing any better at all. We've got 1 apple, but for reasons which are not important, it sells for $2. So in terms of the market value of all final goods and services, we have 1 apple times $2, so it's 2. But if we think about adjusting the price for inflation, what we're going to want to do is pretend that it's sold at our base year's price, because you can see from this example that it's the same amount of product. All that happened was the price doubled. So to adjust it for inflation, let's bring it back to the price it would have sold for were it 2019. And that's real GDP. So nominal GDP is the sales price. Real GDP is the inflation-adjusted price. And which one of these is giving us a better indication of whether our economic situation improved? Real GDP, obviously. Nominal GDP makes it look like we've doubled. We're doing great. And real GDP tells us, no, we didn't double, the price just went up. So for example, if in 1 year the United States nominal GDP was $17 trillion, the next year it was $18 trillion. If we only use nominal GDP, we don't know how much of that extra $1 trillion really was the production of more goods and services, and how much of it was inflation, was the prices of everything going up. To find that out, we need to correct it for inflation. Let's go to 2021. Let's get this apple tree more productive. There we go, 2 apples. I know they're littler, pretend they're not. 2 apples, we'll have them sell for $3 each. My nominal GDP now is 2, because 2 apples times 3 is 6. And my real GDP, 2 apples, selling them at the base year price is 2. So again, you can see that real GDP has given us a much better idea of what happened in terms of the amount of goods and services produced. It's doubled. 1 to 2 is double. Nominal GDP, 2 to 6, makes it look like they tripled. So if I was to ask you whether you believe that real GDP gives us a good idea of how well a society is doing and a good measure of its well-being, I suspect many of you would say yes, or certainly better than the nominal GDP number does, and that's true. But there's something else we want to consider, and that is our population. So I'm going to draw a line down here. I'm going to make this newly created column population, and I'm going to say that the population of this society was 10 people in 2019 and 10 people in 2020 and 40 people in 2021. So now let's calculate what we're going to call the per capita GDP. And we're going to do per capita real GDP. We're going to be using the real numbers because we've already decided that real GDP gives us a better measure of well-being than nominal GDP. So per capita real GDP, to get this we're going to divide real GDP by the population. So 1 divided by 10 equals 10 cents. So it's basically saying that on average we're all making 10 cents, so we're buying 10 cents worth of these apples, 1/10. We all get 1/10 of an apple. We're going to have to be on diets. And we see the same thing in 2020, we're at 10, but in 2021 we're at 5 cents. So where real GDP definitely told us that the output doubled, per capita real GDP tells us how much of it on average each of us are getting. So adding the population helps. I think I will do another example in 2022, but I will let you guys figure out the numbers. So in 2022, let's keep 2 apples. Let's give them a price of $4 each, and go ahead and pause this and go ahead and calculate nominal real GDP, and per capita real GDP. Let's keep the population at 40. So go ahead and pause and do that. Welcome back. If you haven't paused, pause. Welcome back again. Now if you haven't paused, there's just not a lot more encouraging I can give you. So nominal GDP, $4 times 2 apples is $8. Real GDP, remember we're using the base year price of $1, so we're still at $2. We've got a population of 40, so we're still at 5 cents. You know what? Let me have the population unfortunately die, half of them. So we'll do now 2 over 20. I just noticed I have a mistake in the example above this. We'll come back to that in a minute, and I suspect you guys noticed it. But so we're going to 2 over 20 equals 10 cents. Right here, the mistake was in 2021. It's in per capita GDP, and this should have said 2 over 40. Because it's real GDP, which was 2 divided by the population. So 2 divided by 40 is 5 cents, 0.05. So now we have a question of whether we're better off, again, between 2021 and 2022. And so I think your answer is probably yes. I mean, obviously the people who have died aren't better off. But the population is better off economically because now they have an average of 10 cents rather than an average of 5. So the last piece to this is where I let you all know that actually I own the apple tree, and I am going to keep 1.5 apples for myself, and the rest of you get to divide up the other half. So now we're talking about income distribution, right? So what if in 2021 we all split the 2 apples, but in 2022 I'm taking all but a half an apple, and the rest of you can split that half. I don't have a column for income distribution, and that is because you can't do it numerically like this. You'll be learning about it in economics, but it's just a little bit more complex. But it is a missing piece. We really don't know how well we're doing unless we see the income distribution as well as the per capita real GDP. I had a really simple example when I adjusted GDP for inflation, didn't I? I just said consider what price this was in the base year. But of course we only had one product. And we know in the quote-unquote real world we have all kinds of different products and their prices are changing at all different rates. So we have a formula, but first I want to introduce the term, I mentioned it once before in passing, current dollar GDP. It means the same thing as nominal GDP, and it means not adjusted for inflation. So what it is being sold for currently. The term current dollar makes a lot of intuitive sense. And the other term for real GDP is constant dollar. So we're keeping the dollar amount constant to what it was in the base year. Nominal or current dollar GDP is not adjusted for inflation. Real or constant dollar GDP is adjusted for inflation, and you might see either term used. The formula is real GDP is equal to nominal GDP divided by the price level times 100. Now the price level is something that you may not be familiar with yet. The price level is not, it's introduced in the chapter on inflation, and you might not have had the chapter on inflation yet. So don't worry too much about that if you haven't had the chapter on inflation yet. We'll go through an example right now, and I'll give you the price level. So if nominal GDP in country X equals 15 billion and the price level is 150, what's real GDP? Simple algebra. 15 divided by 150 times 100 equals 10 billion. Another thing that we might want to do with GDP is calculate its growth rate. Economists are and policymakers are very concerned with the growth rate of gross domestic product. And a difference in growth rate of even 1% can, over time, mean a very large difference in economic well-being. So to calculate the growth rate, it's simply the percent change in GDP from one time period to another. And you did percent change formulas in algebra. And if you don't remember, it's basically x2 minus x1 divided by x1. And then we express it as a percent. And to do that, we multiply it by 100. So GDP growth can be calculated on either real or nominal. The formula is absolutely the same. Any percent change formula is the same. And in terms of gross domestic product, we usually express it annually. So GDP growth would be from 2017 to 2018, or 2018 to 2019, or 1950 to 1951. That's usually how we express it. So in our example, and you can calculate this before you go on and see the answer, and these are actual numbers, 17,938 billion. In 2015, 2014, 17,348 billion. What is the GDP growth rate? So it ends up in decimal form being 0.03401, or basically 3.4%. So we've gone through all the ways GDP is calculated, or two of the ways GDP is calculated. We've gone through some of the things that are left out, some of the things that have been brought up as problems with it. We've gone through how to go from nominal to real. We've gone through GDP growth. And so it's time now for the final thoughts, which is how well does GDP measure a society's well-being? But that's not something I can answer in a tutorial. It's not something I can actually answer for you. But I hope that you'll take some time to think about it, and even more as the semester progresses and you find different ways when it's used and different things that it's used for. So feel free to watch this tutorial absolutely as many times as you need. Get a hold of me if you have any questions about it, and we're done. Thank you very much.